Welcome to Lavelle Law Online. Lavelle Law Online is a series of webinars provided by Lavelle Law to inform the public about particular areas of law in which we have practice groups serving the community. My name is Tim Hughes, and I am a partner at Lavelle Law, concentrating my practice in helping people and businesses before IRS collections and individuals in consumer bankruptcies, both Chapter 7 and Chapter 13. Today's webinar is entitled IRS Debt Relief: What to Do If You Cannot Fully Pay the IRS. And yes, some people and corporations do not fully pay their taxes when they file their return. When people do not fully pay their taxes on time, this creates a deficiency for the government. This deficiency by the government between the amount remitted by taxpayers and the amount of taxes due is sometimes called the tax gap. And this yearly tax gap has been estimated to be about $450 billion a year. The reason for this tax gap, and even the calculation of it, are beyond the scope of this webinar. The existence of the tax gap is real, and for those individuals who contribute to its magnitude, they soon learn that the IRS is more than just an entity that you mail your tax return to each year, or that entity that may do an audit of your tax return if you're unlucky to be selected by their computer. These individuals that file without fully paying their tax soon discover the IRS is a collection agency. In fact, the Internal Revenue Service, or IRS, is the largest collection agency in the country, and by far the most powerful. It is empowered by the U.S. Congress to take actions necessary to collect taxes owed to the federal government. The IRS's wide-ranging power, which includes, but is not limited to, liens and levies, can easily create some fear among those who owe the federal government for unpaid taxes. Today, we will discuss options for those individuals that find themselves unable to fully pay their taxes when they file their return. However, before I jump into the outline, I'd like to invite our listeners, if they have any questions related to our topic, that they can send those questions to us, and I'll try to address them as they come in or during our Q&A session at the end of this webinar. Of course, if you're listening to this webinar after 1 o'clock on November 16, 2017, it's no longer live, but feel free to email or call me to discuss your questions or concerns. And with no further ado, we will look at our agenda in addressing unpaid taxes: filing tax returns on time, seeking extensions to pay, borrowing, installment agreements, hardship, bankruptcy, abatement, and offer and compromise. These are the topics we'll be covering to help those taxpayers who are challenged with the inability to pay their taxes as they come due. Our first topic is file your return on time. It sounds basic, it sounds simple, but I hear so many people tell me, I didn't have the money, so I didn't want to file the taxes. I was going to get the money soon, so I figured I'd file the taxes when I got the money. Or some other excuse on not filing. All of those excuses are terrible. There is no good reason not to file the return, and the reasons for filing are all in favor of the taxpayer. One, it reduces the liability. A good defense is an offense. If you don't have the $10,000 on April 15th, and for this webinar, April 15th and October 15th will never fall on a Saturday or a Sunday or on a national holiday. But in real life, they do, so check the dates carefully. But when a taxpayer doesn't have the money to full pay their taxes on April 15th, they should still file the return or file an extension to October 15th to give them time to get the money to pay that $10,000 or whatever amount is due on their 1040. And these rules apply similarly to corporations for their returns. File on time, file on time. The ostrich defense does not work. And you want to file the return to protect the statute of limitations. The IRS only has 10 years to collect. But if you don't file the return, that 10-year clock does not start. So file the return, file the return. If there's one takeaway from this webinar, it's file the return timely. And you'll hear me say that again later today. But file the return so as to minimize penalties, because by not having the full amount due when you file the return, you are going to be subject to a failure to pay penalty. That penalty maxes out at 25% of the tax. So if you don't have that $10,000 on April 15th and you do not file, the failure to file penalty also maxes out at 25%. So you are now giving the government an extra $2,500 on funds you can't afford, not to mention the failure to pay penalty. The failure to file penalty and the failure to pay accrue at 5% per month starting April 16th. The failure to file penalty accrues per month at 4.5%, and the failure to pay at 0.5% per month. So the takeaway from there is it's important to get the return done, not only to minimize penalties, start the statute of limitations, and if you're looking at other options in resolving, such as bankruptcy, you have to have the return filed. So file the return. The ostrich defense does not work. And filing on time means if you're filing the extension to October 15th, file that extension on or before April 15th. And then when October 15th comes by, file the return. File the return to minimize your penalties. If you filed your return and there's now a balance due, what to do? Well, it depends on your situation. If you've got funds that are just around the corner, you don't need that much assistance. You can just wait till you get the funds and then remit the funds to the IRS. We say call the IRS at 800-829-1040. If you want to waste a few hours, that's the number. But if they send you a collection letter, use that number. But if you've got the money ready or soon to be ready, but you don't want to have extra fees and costs, just request a 120 days extension. There's no user fee. But do not request the 120-day extension if you're not serious about full paying the taxes. Otherwise, that's another strike against you for trying to delay and hinder collection by the IRS. But if you've got the funds for sure around the corner, but that corner is going to take you 3 months to 4 months to get, request the extension, make the payment, pay the small amount of penalty and interest on that delay, and then just move forward. And also it goes without saying that when you file the return, if you have some funds, make a partial payment. Penalties and interest accrue on the unpaid portion. So today we'll be talking about that unpaid portion. If you don't have the full amount, pay what you can to hopefully garner goodwill and reduce costs of carrying your taxes beyond the due date. And when you contact the IRS and say that you can't pay, they're going to ask you, do you have equity in your home? Can you borrow funds? And is there any other source, family, that can give you the monies to full pay the tax? Borrowing on your house, that's a question for you. That's a business decision, because when you file your return, the IRS is a priority debt. Creditors in the world fall into 3 camps. Secured, somebody with a lien, such as a mortgage or a car note, they have collateral. Priority, IRS, the tax man. And then there's general unsecured, non-priority. everybody else, the credit cards. But if you fall behind on the credit cards, they're the first to call and harass you because they know they're last in line. The IRS may not be as aggressive, but they are in a higher pecking order than the credit cards. But to move them from priority to secured is a business decision. So you have to evaluate that call and all the factors in your finances, which is beyond the scope of our webinar today. Loan, borrowing from your 401k or some other asset. Again, you have to decide, does that make sense to resolve the IRS collection efforts against you or incur this debt? File on time. I told you I'd tell you to file on time again. This is not necessarily for that tax year that now has a balance. It is saying, think about the current year. You are calling the IRS about last year, but this year and next year and the following years will all have their own tax liability. Do not borrow from this year's taxes to pay last year's. By doing that, you're going to be accruing more penalties for the same dollars of tax deficiency. You want to isolate, contain that liability, that one tax year or two tax years, and get current. So when I say file on time with respect to this module, I'm saying make sure that the current year is current. And if you feel like borrowing dollars from this year to pay to last year, get over that feeling. It doesn't help, and it just causes problems next year when you file on time this year's tax return. So file on time, make sure this year is current, and address the liability as we will discuss through other options. And we also have listed family. Family can be extended family. I don't know how much you want to go to beyond your spouse, but spouses can also be family. And it may be a question on tax planning. Do you file a joint return or file married filing separately and insulate one spouse from IRS collections? Again, your accountant or our office can help you on deciding what would be the best approach ahead of filing. After you've filed, the ship has sailed, and we just have to address the liability as it is, whether an individual liability or a married filing jointly liability. So if you can't full pay by borrowing or getting your own funds from around that 3 to 4 month corner, the next approach would be establish an installment agreement. The IRS fluctuates their standards based on dollar amount, and that standard deviates every now and then based upon IRS programs and a function of their staffing. But essentially, if you owe less than $25,000 on your one tax year, you can hop online and enter into an installment agreement up to 7 years, pay a user fee that will be deducted out of your first payment, and the user fees can vary depending upon whether you do an automatic debit or agree to just mail-in payments. This streamlined installment agreement is limited to individuals with 1040 liability or a closed business. But if you owe less than $25,000, quite easy to set up an installment agreement with the IRS. If you set it up for 7 years, guess what? You got to file your taxes for the next 7 years on time and also accrue no new liability. If you do, obviously that tax year is going to be a reason why the IRS will say this current tax year's installment agreement is defaulted, and you now have to address a multiple year liability that may exceed $25,000. And if the liability is over 25 but less than 50, you can complete a simple, relatively simple form, 9465, and again request an installment agreement up to 72 months, pay a user fee, and move forward with, again, compliance, 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 compliance. File on time, accrue no new liability. So again, when you address the installment agreement, you want to make sure a budget item that you have is current year taxes. Because if you accrue a new liability, the installment agreement you worked hard on gets defaulted, and now the liability is larger because you got a new tax year with new penalties, either failure to file and or failure to pay, hopefully just the failure to pay, but new tax years should have no penalties. It's the old tax year or years that we're trying to contain and resolve. So stay current, stay current, stay current, stay current. And if your liability is over $50,000, you now have to complete an IRS Form 433A, which is somewhat intrusive, but your liability is over $50,000, and that is a sizable amount. The IRS is now going to be looking at your budget to say, is your monthly budget reasonable? And do you have assets that could be used to full pay or substantially reduce the liability? And no client wants the IRS second guessing their lifestyle, whether the assets they have or their monthly budget. But when the liability is this large and a 433A is completed, the 433A addresses your monthly budget, showing your household income from all sources and your expenses. Housing and utilities. The IRS has spent lots of money to determine how much a household of 1, 2, 3, 4 should be spending on housing and utilities for every county in Illinois and in every other state. And they use this standard, which some say is somewhat outdated and a little less generous for a taxpayer, to say this is what your family of 4 in Cook County should be spending on housing and utilities. If your actual expense is greater than that, we'll allow you your actual expense for 1 year, but then the difference, your overage of what you're paying compared to the IRS standards, will have to be thrown in to the installment agreement. So you may be able to get an installment agreement relatively low for 1 year based on a high mortgage or rental, but then after 1 year, it's going to possibly skyrocket. But it's not just housing and utilities the IRS looks at. It's national standards, food, clothing, and miscellaneous expenses. Your family may have become accustomed to a certain lifestyle. The IRS is going to say a household of 2, a household of 4 has to allocate this for food and clothing, and the excess should be used for the IRS installment agreement. Transportation is another category the IRS has a standard for, and there the car note may or may not be allowable in total. The IRS allowance for cars would be 1 per person for the taxpayer and 1 for his spouse. Children in the household do not get a car payment, and operating expenses are for the 2, the mother and the father, or the husband and wife taxpayer, and the kids' transportation is bundled up or rolled into sorry about that, I just saw that we had a question about the $25K limit. Is it for 1 year or a total? Well, if you did some bulk filing and have a 3-year total liability, it is in total, and it's the taxes, not the penalties and interest. So if your 12, 13, 14, 15, and 16 return liability totals $24,990, you can enter into an installment agreement relatively easy. If it's above that, pay it down, but it's not per year, it's a cumulative number. Going back to the over 50, the national standards, in addition to Housing and utility, food, clothing, and transportation also have out-of-pocket health care. The IRS is going to allow you a miserly number based on your age, either under 65 or over 65, and they will also allow you to get the credit or the expense allowance for the full amount of your out-of-pocket if you're able to document it. And documentation of medical expense out-of-pocket may be easier now than in the old days. The drugstores keep a good tally of what you spend, and if you keep good records on your other doctor bills for out-of-pay or out-of-pocket copay, that can all be bundled into exceeding the IRS allowance. But then the IRS will look at what your other expenses are and pretty much disallow anything else that is not in conformity with their standards. So owing more than $50,000 puts a great burden on the taxpayer for meeting that liability. Thus, why I always say file on time, file on time, file on time to minimize that failure to file penalty. And also be sure to pay down as much as you can because, again, the penalties and interest accrue on the unpaid portion. If you have a taxpayer and they had a liability as a result of whatever life event that caused the liability, and they cannot under any circumstances borrow or enter into an installment agreement that will satisfy the liability. If they could enter into a small installment agreement, they may get a chance to get a partial payment plan, which is that the IRS will recognize a small dollar amount for the life of the collection statute, 10 years. But a more realistic approach to addressing the hardship the taxpayer is experiencing is to have the account placed into hardship. Hardship sounds exactly what it is. The taxpayer can't meet their ordinary necessary living expenses and needs help. So depending upon the size of the liability, if it's over $50,000, a 433A. If it's under $50,000, a 433F, which is a two-page personal financial statement, less intrusive than the 433A. It's prepared, and the IRS decides whether your account can be put into hardship. Being put into hardship is not a solution. It is a temporary bandage. It's kicking the can down the road. As I mentioned, the IRS has 10 years to collect on each particular tax year. So if you owe for 1 year, it's just writing it out for 10 years on that one. If you owe for 2, 3, 4, or more, each tax year has its own module or liability and its own 10-year statute of limitations. A hardship says that the IRS will not waste its resources, time, and energy trying to collect from somebody who can't make their ordinary necessary living expenses. The hardship does not stop the accrual of penalties and interest, and I forgot to mention in the installment agreement in Module 4 that an installment agreement does not stop the accrual of penalties and interest. It just stops IRS enforcement of collection with respect to levies, where they will not try to garnish your bank account or your paycheck or any other assets that you may have. They're content with the installment agreement payment plan that you're making and their accrual of penalties and interest on the unpaid portion. Hardship, again, does not stop the accrual of penalties and interest. It stops the IRS enforcement. They will not levy a bank account. They will not garnish a paycheck. They will just flag the account to follow up in a couple of years unless if your income, when you file your return, indicates that you've had a great change in financial circumstances for the better. Then, in which case they will take your account and bring it out for review to see, can you full pay it? Can you enter into an installment agreement? So hardship is a temporary solution. It may be what's necessary for other purposes, if bankruptcy is going to be a strategy down the road, or just where life has put the taxpayer that they need a little relief till they get their feet back on their ground so they can then borrow funds or enter into an installment agreement. But hardship is only temporary unless I've had a few pro bono cases where we've put the client into hardship almost every other year, and then eventually each and every tax year falls off with the taxpayer ending up not paying anything. But that is a long, stressful situation for that taxpayer to have the IRS hovering over them for 10 years or more, depending upon whether there's multiple years. But hardship is another type of solution for, or not solution, sorry, approach to address unpaid taxes. Our next module is bankruptcy. And some of you may be shocked, are taxes dischargeable? Well, it depends upon a lot of factors. One, is it income tax? Is it 1040 tax? Then the answer is it may be possible to have that tax year or tax years discharged. And we will go into depth on that. Or if the income tax is a trust fund tax, then it will never be dischargeable. If you don't know what a trust fund tax is, there's a good chance you don't have to worry about that unless somebody, a spouse or business partner has kind of set you up for it. But essentially a trust fund tax is where the corporation or business collects tax for the government. What do you mean, collects tax for the government? You're an employer, you hire an employee, you give him $100 a week, he gets every Friday a check for $70, and you're holding $30 to remit to the IRS, Social Security, Illinois Department of Employment Security, and Illinois Department of Revenue. That monies you're holding back is a trust. Or you're a retailer. You sell $100 of goods, collect $109. That sales tax is a trust. Today's discussion is IRS, so we're not going to talk about the Illinois Department of Revenue, but just to kind of clarify what a trust is versus income tax. So, can income taxes become dischargeable? There is a 4-part test for income taxes to be dischargeable. And the first 3 are very objective, and the 4th one is very subjective. And the approach on dealing with the dischargeability of taxes in bankruptcy is very factual and intensive depending upon the part 4. But to get to part 4, you have to meet the first 3 parts. Is the tax year older than 3? Watch out for extensions and tolling. There's a few items that can toll the extension, and if you filed for an extension and still filed the return timely, the extension is the controlling date. So older than 3 years means here we are in November of 2017. So 3 years ago, or 4 years ago, would be 2013. 13 was due April 15th. Again, today, April 15th and October 15th never fall on a Saturday, Sunday, or national holiday. So 2013 return was due April 15th. If your accountant thought he wasn't going to be able to get your return filed by April 15th of 2014 and he filed an extension, your return is now due, or was due, October 15th, 2014 for calendar year 2013. October 16th, 2014 is the controlling date. Add 3 years to that, and 2013 would have been dischargeable per the first test last month, in the middle of last month. Of course, if you didn't file an extension, you're good at April 16th of this year, unless there were items that told the collection statute. If you filed a collection due process hearing or went to appeals on some item, there could be something that extends that. The second test is return filed at least 2 years. Remember Module 1, file the return, file the return. If you don't file the tax return and the IRS files their tax return, the substitute for return, you will never have been considered able to meet the second test. So file your return. The third test is the assessment by the IRS has to be at least 240 days before you file for Chapter 7 or Chapter 13, bankruptcy. So that, again, can be told by certain events, going to collection due process or a prior bankruptcy or other situations. But these first three criteria are pretty straightforward. Pulling up an IRS account transcript, you can review that document to see if you meet these three tests. And then the question is, do you meet the fourth test, which is not objective but subjective. The fourth test says the liability could not have been accrued based upon fraudulent conduct. Wait a minute, you owe tax. Isn't that fraudulent conduct? Well, in bankruptcy, the bankruptcy judges see a lot of debtors. So having a tax debt does not mean that it's fraudulent conduct. There's going to be a lot of items looked at, and the short, small list in this webinar is not all-inclusive. It's just some of the favorites that get looked at. So it's very important if tax debt, sizable tax debt, is looking to be discharged, sizable being probably over $100,000, that you want to carefully look at what triggered that liability. If it's under $50,000, you don't probably have to worry so much, but again, each case is fact intensive. If you're between $50,000 and $100,000 of liability, then you're in that gray area, and then that's when you have the heart-to-heart and talk about best approach. And that's a little beyond our scope, and we've got a few other items, and we still have to talk about fraudulent conduct. First item they look at is, was there willful concealment of assets? If the IRS has been trying to collect against you, and they've been maybe trying to collect for 3 years, have you put all your property in the names of family members or other entities that are supposedly not yours? If you've had that kind of conduct, if you're living in a very expensive house or driving expensive cars or have other expensive toys in your possession, not necessarily title to that, then the IRS may challenge whether your taxes can be dischargeable. The next item, fraudulent transfers. What's that? Well, you think, I can't hide from the IRS for 10 years. I don't want them to get my boat, my plane, my Porsche, my whatever. So I'm going to sell that asset for $2 to my brother. That would be a fraudulent transfer. And that's the gross example. There's more benign. And again, each case has to look at it in respect to the liability and the conduct of the taxpayer before the liability accrued. If he had all those toys before problems occurred, then why didn't he liquidate some of them to pay down the taxes? That's the IRS's position. Maybe he liquidated to save the mortgage, or a spouse was dying of cancer, or a parent was going to be having some kind of surgery needed that he needed to liquidate assets. So just because something happened, it doesn't necessarily mean that it's fraudulent, but have to look at it and see what the story is related to that. Number 3, conducting business affairs in a manner intended to make tracking or levying on income more difficult. If you change your bank account every 3 months because you're worried the IRS is following you, that could be a problem. If you're refusing other types of normal business conduct to get a cash basis for revenue, may be a problem. Number 4, or D, significant understatement of income. If every year you say you make $25,000 from your business and that supports your mortgage of $600,000 and your car payments and other things, and each and every year the IRS comes in and audits you and picks up your income from $25,000 to $200,000, may have some issues with that test. Repeated failure to file returns or habitually late filing in the wake of past compliance. Well, if you had a bad accountant and you always trusted the accountant to file the return and he filed them in his cabinet and not with the IRS, was it your fault? Yes. You cannot delegate the filing responsibility, but in that fact pattern, somebody interfered, so you're needing to file 8, 9, 10 years of tax returns all at once, maybe arguably because of this accountant or what other event. But if the IRS is knocking at your door saying provide documents and you delay and hinder that collection effort, then you're going to lose credibility for those tax years being dischargeable in bankruptcy. Failure to cooperate with taxing authorities, kind of like E above, the IRS has contacted you and said, please provide us A, B, and C, and you provide them X, Y, and Z in hopes of that they'll go away and not bother you. Not a good approach, because that could be a strike against you. Filing false forms. I don't think we need to spend a lot of time on this one. Each tax form is signed under penalty of perjury, so filing false forms doesn't win you any points with the IRS or the state of Illinois. Throwing that one in for free for you. Statements indicating an intent to evade taxes. People have gone on YouTube or on their Facebook account saying that the tax code is, I want to keep this in civil discourse, so I won't say what they really say, but they're saying that it's not valid, but it is. So trying to rouse others to not pay or file taxes is not going to endear you to the IRS. Next one, which may be a result of H, but in I we have criminal conviction for tax evasion. Could that be discharged in bankruptcy? Possible. It depends what the facts are, because believe it or not, criminal conviction or the tax due as a result of a criminal conviction or the criminal conduct could be compromised in an offer in compromise to the DOJ. So just because the liability is there doesn't mean it may not be dischargeable, but you do have an uphill battle in that case. J, inability to explain deductions and calculations of income. Here, if you may not have been the perpetrator of some bad tax or false filings, but your accountant said, yeah, claim this and you get a bigger refund, and you do, and then you go into an audit and the auditor says, why do you have a steady $2,000 of income on this business? And you think, well, I don't even have that business. The accountant must have said I had this business, so I got an earned income refund credit, or that I could claim a large loss because of all those expenses for a business I don't have, and then use that loss to offset some other income. You're signing the tax return. You should know what's on that tax return. So an inability to explain it other than, I think the accountant prepared that, is not going to win you any points. Involvement in tax protester activities. That was kind of those statements about the tax, but here you're joining a known tax protester in challenging the validity of the tax laws. Doing this may cause the tax liability to be non-dischargeable. Our firm, about 15 or closer to 20 years ago, helped a tax protester. We got him back on the straight and narrow, had him sign an affidavit saying he was renouncing his wayward ways, and he filed tax returns to replace his prior tax returns, which on every single line of the 1040, other than name and address, had First Amendment. He had a liability of about $530,000. We compromised it through an offer in compromise for $5,000, based upon his now being back on the straight and narrow. But if you want to stay with the tax protesters, you're going to have to live with them. And that may not be where you're currently residing. Next item, failure to pay taxes despite the ability to do so and living in a lavish lifestyle. Again, if you've got a large liability, that doesn't necessarily mean you're a bad guy. But if you're living high on the hog and not making any effort to pay down the liability, the bankruptcy judge may not favor dischargeability of the taxes if the IRS challenges it. So you know it when you see it, kind of applies here. And then the last one we listed, but again, this is not an all-inclusive item or listing of fraudulent conduct, implausible or inconsistent behavior on the debtor's part. Implausible. You say you only make this kind of money, $25,000 a year. You have a mortgage of $600,000 a year that you're paying with property taxes, $8,000 a month, a mortgage payment. You've got a $1,400 car note payment, and you do all that on on $25,000 a year. Well, I have friends who help me out, and I take those funds and I put them in my bank account. Would you disclose those friends? No, my friends don't want to get involved in my mess. A little implausible or inconsistent behavior. So the dischargeability of taxes can be done if they meet the four-part test, and dischargeability of taxes can be done in a Chapter 7 and through a Chapter 13. This is more a tax talk, so I'm only going to spend a minute on the difference between a Chapter 7 and a Chapter 13. Chapter 7 is a liquidation, which sounds terrible, but most people try to do that for ease of more bang for their buck, that it's cheaper, simpler, and easier. And if they don't have assets or high income, the 7 can be started and completed in 4 months, and this bankruptcy issue with respect to taxes could be done 30 days after that. So in about a 5-month period, you could know that that nightmare of 4 or 5 years is finally done. In a Chapter 13, you're making payments for 3 to 5 years. But again, you may be choosing 13 because of too much income, too much equity in an asset, or you've looked at your tax liability, and your tax liability is made up of a boatload of different tax years, and the most recent 3 have some large liabilities, and you cannot convince the IRS to set up an installment agreement that you feel comfortable with. A Chapter 13 could be a way to force an installment agreement on the IRS where you couldn't get them to agree because of national standards, although the bankruptcy court does use national standards in applying IRS national standards and applying the bankruptcy code. But in approaching the IRS in an installment agreement, that $300,000 that you owe has to be full paid in that installment agreement, unless if you can convince the revenue officer that a partial installment agreement should be done. Partial installment agreement is where you make the monthly payment and the revenue officer has convinced his manager that that amount of payment, factoring in the taxpayer has no other assets, that amount of payment is the best we can do, and as the old tax years fall off, they fall off, but this guy is going to be paying the most that he can. But partial installment agreements are difficult, and again, they can go the life of the statute of limitations, which for the most recent year may be 10 years. So that could be a long payment plan. Chapter 13 is 5 years, half that 10 years. And more importantly, the revenue officer was looking at that $300,000 liability. The bankruptcy court is looking at each tax year and saying, is it secured? Is it secured, in which it has to be full paid? Is it priority, in which it has to be full paid? Or is it dischargeable, in which case it is now a general unsecured non-priority debt and can maybe be paid at 10 cents on the dollar? So that revenue officer in an installment agreement was looking at $300,000 that had to be paid. Now the bankruptcy trustee and IRS is looking at a debtor that has $200,000 that can now be paid at 10 cents on the dollar, and $100,000 that has to be paid in full. 110 may be feasible for this taxpayer in a 13 to full pay and get the discharge at the completion of the Chapter 13. So, sorry for tax guys for spending so much time on it, but it is a viable solution for resolution to the taxes or forcing a pay plan on the IRS. The next item, abatement. Abatement will not resolve a tax liability, but kind of like filing taxes on time, it reduces the debt. In our example of having a $10,000 liability on April 15th, in abatement, if you can reduce the penalties, that taxpayer may be able now to get a loan to full pay or have a smaller installment agreement where now he can full pay and not have to worry about pulling his child out of private school. So an abatement is not a total solution unless if it's to a trust fund tax where you've been chosen or deemed by the IRS a responsible individual, a person responsible for the collecting, accounting, and remittance of employment tax. If we can show you were not a responsible individual, not trying to degrade you, but trying to say that you were not responsible for the collecting, accounting, and remittance of taxes for the corporation, and that your role was different, it was in a different area than collecting, accounting, and remitting of taxes, you may get that assessment totally abated. Or you may have been a responsible individual for maybe 1 or 2 quarters and not the 6 quarters the IRS is coming for. So an abatement, depending upon the facts and situation, can help with full payment by lowering the total debt, with an installment agreement by, again, lowering the total debt, which will help in the installment agreement. In bankruptcy, if it's going to be dischargeable, it's going to be dischargeable. And again, we mentioned trust fund is not dischargeable, but penalties in bankruptcy are dischargeable. But if you wanted to avoid bankruptcy and try other approaches, an abatement can be in tandem with an installment agreement or a full pay. Or an abatement after a full pay is a refund. So that just has to be done timely to get the monies that you overpaid. So with that, we will now approach our last module, offer and compromise. There are essentially 3 types. Doubt as to liability. Here, you know it when you see it. It's essentially an audit reconsideration saying, I was out of town. I never got notice that the IRS was going to do these changes, or the auditor that made these assessments or changes didn't notify me timely, and I have this assessment. But look, I have the facts and why my tax liability shouldn't be $100,000, it should be $5,000 or whatever. But it is not saying that it's not fair. The doubt as to liability is based on facts and law, not on equity that I shouldn't have to pay these taxes. The second type of offer and compromise is the more common, doubt as to collectability. Here, the taxpayer has to put all his cards on the table, essentially, and fill out a 433A OIC form, which discloses all his hard assets and all his disposable income. And if he has a business, he has to include the 433B, which is another 6-page financial disclosure form requiring detail of assets and income. And then the IRS takes those forms and evaluates the taxpayer's financial situation to determine if an offer in compromise, which is a contract with the government to have the government accept less than what is on their books for purposes of settling that taxpayer's claim or account. And the reason they do that is, as the title of this type of offer is, doubt as to collectability. The IRS does not want to waste time and energy and its limited resources, which are vast, on chasing a taxpayer if they can get more dollars from that taxpayer through an offer in compromise. But they will allocate resources to harass a taxpayer if they cannot get a resolution. So doubt as to collectability, you're saying there is a doubt. If there's no chance, if your career is skyrocketing and you've got assets, filing a doubt as to collectability is a stalling tactic which will earn you no points with the IRS. Penalties and interest still accrue while an offer is being evaluated by the IRS, and if they reject it, you have now just delayed collection for a short period of time. And you'll remember in the bankruptcy module we talked about that tolling, and the offer and compromise tolls the first and third prong. So just submitting an offer and compromise in hopes of getting it settled is a waste of taxpayers' time and energy and helps dig them further into a hole. So an offer and compromise should be submitted when there is a likelihood of having it accepted. And our office has had great success with offers, but we've also told clients you're not a candidate for it. So it really depends upon those hard assets and disposable income. And the hard assets are viewed differently in an offer and compromise than, say, in a bankruptcy or when you're at the dinner table talking about your financial situation with a banker for a loan. The IRS will take the fair market value and knock off a liquidation amount, which it may be generous depending upon the nature of the asset, and then the net equity, if there is any, if there's secured assets or secured creditors, that can take that asset out of the range of collection. Or if you've got a business and that business is what's putting the money in your bank account each and every month that puts food on your table and keeps the lights on, we can try to say that that asset should be excluded from the calculation because all of its income is flowing through to the individual taxpayer, and that taxpayer is now in front of the IRS showing his monthly budget. So it's very fact intensive, but it is a good solution for many taxpayers who have hit a hiccup And in fact, the requirements for an offer in compromise, not only saying I will settle with this or settle my arrears, and again, it's always arrears. You got to contain the liability. A term of the offer in compromise is that the taxpayer is going to be back on the straight and narrow for 5 years. If he or she or it defaults during that 5-year post-acceptance, the IRS can declare the accepted offer in compromise void or defaulted and resurrect those liabilities with now the accrual of the penalties and interest. So again, file on time with appropriate extensions and pay going forward. And if there's a problem in the past, deal with it through an offer in compromise, bankruptcy, or an installment agreement. And I still want to get to the couple of questions that we've been emailed earlier. After doubt as to collectability, there is exceptional circumstances, effective tax administration. You know it when you see it. These are very difficult because to meet the threshold on an offer in compromise, exceptional circumstances, effective tax administration, you have to say, dear IRS, you can fully collect from me. But it wouldn't be right because then I would be in such dire straits that it would just be appalling to the conscience, and the public would be dismayed that you keep pursuing me. So an ETA, effective tax administration, is a possibility but very difficult. And we are approaching close to our end of our time. So I apologize to the one individual who sent in an email regarding offers in compromise. Is there a way to address the 80% payment on the offer in a creative way? And the short answer is yes, by possibly defaulting on your mortgage and having a Chapter 13 as a backup. But the other individual who wrote in a quick question, they asked about what about these new collection agencies being retained by the IRS. Earlier this year, 2017, Congress allowed 3 collection agencies to be employed by the IRS, and they get a set inventory to work. When or if your client were to get that letter, have them call me or email me, because there's a nice response to that. And with that, I think we've got no other questions in the queue. So I thank you for your time here. And if there's anything that I went too quickly on, please feel free to contact me at Lavelle Law at my email, thughes@lavellelaw, or contact us using Facebook, Twitter, or LinkedIn. And thank you very much.